And welcome back to another exciting episode of The Road to Financial Independence. I'm your host, Mike Riskin, president of CPS Investment Advisors. And as always, I'm joined by my partner, co-host, CEO of CPS, Peter Golotko. Hey, Pete.
Hey, Mike. How you doing?
Doing terrific. How are you today?
I'm doing great.
Well, Happy New Year, Pete.
Happy New Year, Mike.
Well, welcome. 2026 is here. I cannot believe it.
I can't believe it either.
I feel like we just sat here and we're doing the What's New for 2025 podcast.
It goes by pretty quick.
That's right. And we had to get our crystal ball out again for this upcoming year.
Yep.
And I think it was kind of neat last year throughout the year during the podcast. You know, we did the first quarter market update and what's new for 2025, and you made some predictions, or we just kind of banter a little bit about what we thought, and throughout the year we kind of played some of those clips and kind of looking back. I mean, obviously it wasn't 100%, but I feel like a lot of the themes we discussed and sort of the flow of the market was kind of equivalent to what we had thought at the beginning of last year.
It was. You know, when you got a new administration coming in, you got a lot of moving parts. There's people that agree with it, that don't agree with it. It's always going to be rocky.
Right.
And we saw that. We saw the market take a wild swing when our president wanted to fire the Fed chair.
That's right. And the whole tariff tantrum.
And then when he said, I'm not going to fire the Fed chair, then the market went right back up. And what people don't realize is the market doesn't run on our government. Our government only hurts our economy, okay? Our economy runs on us. If we're spending money and we have a good outlook on our job, our economy is going to do well because we're going to get out there and spend money. It's when people stop spending money because they're fearful of something. That's when our economy starts to hurt, and that's where government comes in.
Right.
They make you fearful, and unfortunately, there's not a lot of really great people out there giving great information.
Sure.
You hear one thing, and then you hear the opposite. And neither of them are actually correct a lot of the times. So you really have to take a look at what you're hearing and do your own research, right, because it's pretty amazing what people will say to make you scared.
Sure. No, absolutely. And to your point, I mean, we've always said that the biggest fear in the markets is uncertainty. And then when you have a new administration, there's that lot of uncertainty that comes in there. And heading into year 2 of this administration and sort of the economy, even though I guess this administration can tend to, you never know what might happen. He is very transparent a lot of times about what he wants to do and possibly how he's going to go about doing it. And Correct. So heading into 2026, I think there's a lot of themes where there's a little bit more predictability of what might be going on. And so, of course, we love data. Yep. And so we're going to look at some data to help support some of those things and,
right,
and maybe make a prediction or two again. Who knows?
Well, I mean, if you take a look at what we have coming up, we've got the big, beautiful bill that's going to come in. We've got, immigration. We got a lot of stuff out there going on that's a hot topic that's on the news all the time, and it makes people scared.
Right.
Even though it might be good, it still makes people scared.
Sure.
So I think, like last year, the first quarter is always pretty tough.
Yeah.
And I think this year with the midterm elections coming up, the news is going to get pretty brutal.
That's right. Yeah, the second half of the year could be really toxic again.
And one thing that, I would like people to do is turn that off, because if you look at politics, it doesn't run our free market, period.
Yeah.
If you're not fearful of your job, keep spending.
Right.
Yep.
Yeah.
That's it.
There you go.
So,
keep it simple.
Keep it simple.
and focus on things you can control.
That's
and
correct.
And the important things.
I mean, these talking heads up there make no sense a lot of times, and people like to believe what they say. Well, they don't control everything.
Right.
They just want you to think they do.
That's a fair point. So. Yeah, absolutely. So let's dive into some of the. Let's start out by sort of looking back a little bit, and the numbers. I think most people had a good positive year.
Yep.
some people may have done better than others. And I think it's important to understand when you look at the markets last year, you sort of had a couple different things going on relative to performance, say, or indexes and those types of things. So maybe kick it off with maybe looking at those numbers and then sort of let's get into dissecting of which maybe sectors did better than others and what you owned and why you owned it.
Well, if you are owning good quality American companies, you didn't do very well last year. Why? Because they weren't in favor.
Right.
What was in favor was AI. And there's a lot of risk around AI, and I want to get into that a little bit. But if you take a look at the S&P 500, it returned about 16%. And most of that return had to do with the Magnificent Seven.
Right.
However, if you really look at the data, it's not the Magnificent Seven. It had to do with a lot of the AI companies that were down the list in the S&P 500 that actually grew to the point where they are legitimate AI companies on paper.
Okay. That's a key
and,
point.
I look at the situation with ChatGPT, Oracle, and NVIDIA. And this is an interesting situation. I'll get into this a little bit more in detail, what other people think. But what NVIDIA did was it invested a lot of money into ChatGPT. Now, ChatGPT doesn't make any money yet. Okay, you're still paying your $20 a month for the premium version. But ChatGPT went out and contracted Oracle to build their data centers. They're going to pay them $90 billion a year for 10 years, $900 billion contract. That day that it was announced, Oracle went up 25%. No money changed hands, and no ground was broken.
Right.
Okay? It was just a promise. In turn, Oracle said, we're going to build all these and we're going to buy all of our chips from NVIDIA. So they signed a contract with NVIDIA to buy all their chips, which was worth hundreds of billions of dollars. No money changed hands. NVIDIA went up. ChatGPT went up. So there's an issue out there.
Yeah, a little circular financing maybe.
A lot of circular financing. There's, my fear is there's some accounting irregularities going on. We really don't know what's underneath the hood here.
Right. I think that's a key point.
Correct. And if you're making deals with hundreds of billions of dollars on infrastructure and you haven't even broken ground, how is that value anywhere?
Yeah.
So that's really what we're starting to see is where these companies like Oracle ran up on the S&P 500 because of these deals that they're signing, but no revenue being held.
Yeah.
And we're starting to see outside of the Magnificent Seven, we're starting to see Palantir, a lot of these other companies rising within the S&P 500 and drawing that return up.
Right. And really that was big time in the tech sector, right? Where that sector certainly helped lift everything up. And even when you dig deeper into even the S&P, when you look at I think 42% of the entire S&P was valued in just 7 companies.
I know.
And then, like you said, even looking down the list at the ones that really made that double-digit plus great returns, really were all tech. So the key here is, yeah, I mean, if you were all in on tech last year, you were probably you did very well. But when you look at your risk profile for those long-term investors, which that's typically our typical investors, your long-term, your retirement folks, trying to look at safety over getting the next hot thing. You really need to focus on that balance. And one sector was up here, the rest of them did okay. But relatively speaking, you may have said,
they didn't do well compared to the market.
Why didn't they all do this?
Yeah, right.
And so, as we know, sectors go up and down and whatnot. So,
and like mutual funds, if you look out there, every mutual fund has NVIDIA in it. Every mutual fund is rolling the dice with a big portion of it in some pretty risky investments. And NVIDIA was 7% of the S&P 500, which is a pretty out of 500 stocks, it's 7%.
Right.
And it was a $5 stock in 2020.
Yeah.
So I've been keeping an eye on NVIDIA, and I scratch my head a lot because of all the hype and everything going on. It's a chip company. And we saw the same hype in '99 with Intel Inside.
Yeah.
You know, Intel Inside was in every single computer manufactured at that time.
Right.
And they didn't do very well.
So it's just a buyer beware, keep diversified. And when you look at the kind of the S&P by sector, you kind of see from a return standpoint, really every sector was well under what the S&P, so to speak, did.
Absolutely.
Except for the one which really pulled it up, I guess I could say.
So the reality of it is, if you weren't in the AI sector, not just AI, but if you weren't in the companies that are driving the AI sector, you underperformed the market.
Yeah.
That's just the way it is.
Yeah.
And that's not a concerning thing in my point, because what goes up fast usually comes down fast.
That's right.
And the biggest concern I have with AI is not, I think AI is going to be here forever. I think we're going to be able to use AI. However, I don't think AI is going to be what everybody thinks it's going to be.
Yeah.
And I look at how they're charging for AI right now. It's a subscription.
Right.
You pay for the best ChatGPT. It's $20 a month. All you got to do is go to Microsoft. They've got a subscription and see what their revenue is. Do you think they're going to make this hundreds of billions of dollars back in infrastructure anytime soon? That's what scares me is all this money is going. Now, if you look at Facebook, you look at Google and all these big companies, they've got the money to spend.
Right.
They got the money to throw at this.
Yeah, because they're making so much. Their revenue base is very diverse.
Very diverse.
Yeah.
They don't need AI to continue.
Right.
AI is something that they're rushing to the top.
Right.
Who's gonna make it?
That's right.
But my fear is this. I took a look at what happened in '99, 2000 with the .com bubble, and everybody's wondering who's going to win the .com. Well, nobody won the .com, but everybody won the .com. There's hundreds of thousands of .com websites out there you can go use.
Right.
It doesn't matter what you want, it's out there. Somebody's got it. Now with AI, and let's say ChatGPT starts pulling away and they start charging more for their AI. Well, Grok comes out free.
Right.
Do you think they're going to be paying for ChatGPT?
So the innovation is going to create competition.
Innovation is going to create competition, and competition is going to draw the price tag down.
That's right.
And somebody's going to be out there holding the bag with all of this CapEx that they're putting into it.
Right.
I still have to be sold on all of these data centers, because as a college kid, one summer I worked at IBM, and this was before desktop computers came out. So we were just working on mainframes,
right.
And we were copper plating the panels. And these mainframes were the size of a house. And the data we could keep in it was megabytes, not gigabytes, not terabytes. Your cell phone can handle more data than those big computers can. And that's what technology does. As we go along, things get better and things get easier. Yeah. And if we're building all these centers,
right,
eventually they're not going to be needed anymore.
No, that's
because
a fair point. Yeah.
And then we're going to have all this infrastructure we poured all this money into. I'm not sure who's going to win or what the revenue is going to be. So there's plenty of time to invest in AI when we find out what's going to happen. But right now, there's so much risk out there.
That's so true. And not to mention even talk about the energy pull that these things.
Oh, yeah.
I mean, right now, I don't think that infrastructure is not out there.
It is not.
It's still being,
And, they're talking about building nuclear power plants around these. I'm thinking, do we really need all this?
Well,
I don't know.
To be determined, and I think that's a good segue into the 2026 as we look forward here and what the risks are out there. So 2025 happened, great year in tech, decent year overall for other sectors. But of course, the question we get asked a lot is there a bubble? Is there a bubble? Is there a bubble? Is the market overvalued? So from that standpoint, kind of maybe. Let's hit on that a little bit. Mm-hmm. What 26 looks like in the market, where our concerns lie. I know we discussed our concerns do lie in that sector in particular. So what are some other things you're looking at?
Well, I think right now the AI is a house of cards.
Okay. as a whole, as a sector as a whole.
As a sector as a whole.
Okay.
And the reason why I say that is there's so much money being pumped in there
Right.
with zero understanding of a return on investment.
Yeah.
Okay. So when people invest their hard-earned dollars, the first thing they're looking for is, what's this going to make me? Is this going to return something to me? Well, right now, we don't know what that's going to look like. So there's no ROI, guaranteed ROI going into these companies.
Right.
So, what we look at is, I want an ROI. I want to make money on this. I'm not going to roll the dice and hope that this one wins.
Right.
I want to win every day.
Yeah.
So I always recommend you can buy these high flying when they become good companies.
Right.
But right now, don't get caught up in the hoopla and the shiny stuff where everybody, I'm going to miss out. I'm going to miss out. A lot of times when people say I'm going to miss out, means that they're not going to miss out. They're not going to miss out on the downturn.
Right.
They're going to get in, and
most people get in too late because
get in too late
euphoria
because everybody's made so much money, and we saw that in 99, 2000, but we also saw that in 2007,
right,
with real estate.
Oh yeah.
People saw all these people making money, and they had to get in there. There were a lot of people left holding the bag. A lot of people lost a lot of money doing that because it was so easy to make money. Let's just buy this, and it's just going to keep going up. Right. That never happens.
It doesn't work in a straight line.
And really, the biggest risk we have right now is somebody to come out and say, "Hey, what's the value of this?
Right.
What's the value of the CapEx?" And start questioning the money going into that. And that's when people start to get a little nervous.
No, that's right.
That's when things could fall apart.
Yeah, go ahead. No, sorry.
Well, that's the house of cards.
Yeah.
There's no returned ROI to keep these prices up.
Right.
Yeah, they may be making some revenue, but at what point are they going to make enough to pay back on the money that's being spent?
Yep. And you referenced some of the research that's out there, and I think one of the things we saw was this MIT research that we saw. Where they researched over 300 publicly disclosed AI initiatives. Talk a little bit about that. So what they found there.
Yep. So companies right now, they're hiring people to come in and take a look at what they can do with AI to streamline, to make people more efficient. And what happened was MIT went out and did a research study. 300 publicly disclosed AI initiatives, over 50 companies, and hundreds of senior leaders. And at the very end, they found out that 95% of the people say they are not getting the return on their investment.
Right.
And I like AI for certain things. I usually write my letters in caveman English, and it allows me to change it into English people can read.
Caveman English is a really interesting style.
It is very interesting, but it helps me write to a point where people can read it and understand it. But I try to do a big spreadsheet study, a little bit of research. And it couldn't handle 1,000 pieces of data. It bombed on me. I worked on it for about a week trying to get it to work, and it wouldn't do it. There's a lot of limitations out there, and it's nice when you first get in there and start working with it, but if you needed to do something pretty strategic, it falls down.
Yeah, I had the same thing with a Word document, and I just wanted it to look exactly the same, formatting, everything, and it did not work out well for me either. So
so
still a lot to work out there.
ChatGPT, we use the Windows version of Copilot to help out on some of the. So there's a lot of different tools out there. I just don't know if there's going to be a winner, or if at the end we're going to have all of these AI tools at our disposal to allow us to make choices on what we want.
No, exactly. And I'm seeing, even on our tax side, what it's done on our tax side, a lot of great things, making tax research a lot quicker, helping identify certain tax planning strategy type stuff. But to your point, I mean, when it's this all encompassing, I still think there's a lot to be written on this.
A lot to be written on this.
So
it's too early.
Exactly. So the markets in general are not all stocks are not at all-time highs, but the market in general is. So So when we get folks looking to invest cash or new money, what is your recommendation at this point?
My recommendation is don't wait.
Don't wait, right?
There's no reason to wait.
Yeah.
If you take a look at how the market runs, it continues to go up.
Yeah.
You know, we're almost at 50,000 on the Dow. If you look at 2008, we're at 6,500.
Right. That's
So
pretty crazy.
I mean, anytime you look at, you might buy in at the high, it might go down a little bit, but you're going to get another high
Right.
pretty soon.
I've always said, if you believe in the free market system, if you believe in capitalism, this country is continuing to grow.
Yep.
Companies continue to grow, and that's what you're investing in,
Yep.
is the growth of individual companies, the growth of the United States economy.
Right.
And
I think everybody needs to dial their expectations back a little bit.
Yeah.
It's not normal to have returns and annual returns above 10%.
no, it's not
8 to
normal.
10% is what the market usually gives.
Right.
During euphoria, that's when we see markets grow
Considerably higher.
considerably higher
Yeah.
than they should. But buying at the all-time high, and there's a study we'll put up on the screen that shows if you just bought at the all-time high, you made more money than if you just bought every day, because the all-time high continues to grow. All right. If you're just buying every day or buying when it's down, you may miss the opportunities out there.
Okay.
So don't be afraid to invest your money at any point in time.
Still plenty of opportunity to make money when the markets are at
correct.
the all-time high. It's at the all-time high in that moment, but it's not the.
It's not the all-time high
There's
forever.
people think there's just artificial ceiling on the stock market, and there really isn't. It's
there
just
isn't.
a product of growth.
That is correct.
Let's turn our focus to really the economy then, and some of the headline makers from last year, and that continue to be themes going into this year. And I think one of the lingering ones that we just can't shake is inflation. So
inflation.
Let's start with that. How does that looking? I know it's chilled out a little bit, but it's still around. People are paying a lot more than what we did 5 years ago for stuff. So let's dive into that a little bit.
Well, there's a reason why we're paying a lot more, and it doesn't have anything to do with the inflation rate right now. Right now, we're about 2.7 to 2.9%.
Yep, which sounds pretty good, right?
Well, historically, it's pretty good.
Yeah.
It is. But if you take a look at what happened between 2020 and 2024, we had a horrible inflation spike.
Yeah.
And when you spike inflation like that and it goes back down to 2%, it doesn't mean costs go down.
That's right.
These are compounding costs. So if 1 year inflation's up 7% and then it's up 7% the next year, that's a 14% increase on inflation.
Yeah.
That's never going to come back down.
That's right. And probably even more than that when you factor in the compounding, because that second seven's on
absolutely.
top of the first seven.
That is correct. So it compounds.
Yeah.
So the reason why people are still paying a lot at the grocery store is because inflation, when it comes down, doesn't mean prices are coming down.
It's just
that just means it's not growing as fast as it did in the previous years.
Right.
So when you go to buy eggs, you're not going to see the 2,000 prices because you can't bring them back down. Why can't you bring them back down? Well, during that period of time, if inflation lasts more than 3 months, you're going to have to start raising people's salaries.
That's right.
And once you raise people's salaries, you're not going to bring them back down if you want employees. So all that salary increase is there to stay.
Yeah.
So now people are having to sell their products at a lot more expensive price.
Yeah, and one of the biggest costs that go into most products is labor. And
Yep.
so and that's something that really, unless you start cutting people, like you said, it's really near impossible to cut their wages. So
That's correct.
Take
That's
that
correct.
away. And so when you look at it, just not to dig too deep and dive into this, but the inflation components, I think, is a good area to look into because.
Well, before we get into that, Mike, let's talk about the percent. Because people are seeing these costs, they don't really realize what happened and what the magnitude of it was, during that period of time. Keeping inflation low is so important for Americans,
right?
Because that's just another tax that you get without representation, actually. So if you take a look at 2020 and the end of 2025, inflation grew 25.1%
In the aggregate.
Okay. That's all items. If you take food and energy out, it grew 23.9%. So in 4 years, your costs grew 25%. Yeah,
that's pretty
That's
substantial.
huge.
Yeah.
That is really big.
Yeah.
You know, if something costs $100, you're paying $125 for it.
Right.
It's a big expense, and we're not going to see this type of inflation correct itself.
Right.
It's here to stay.
And luckily, hopefully we see that curve on that line start to level out a bit as we see it.
We're starting to see that do it right now.
Make a right-hand turn.
Yep.
And so then, and you mentioned gas, energy, and food are obviously the two biggest components.
But you know, if you take a look at what drives inflation, it's not tariffs. It's not really anything other than energy. If you take a look at this chart on inflation components, the green is the energy. Now, when inflation goes up, what's leading? If you take a look at 18, the green's leading. When inflation goes down, what's leading the downturn? Energy.
Yeah.
And you take a look at 21, what led the inflation? Energy. In 23, started coming down, energy led the decrease.
Right.
So if you look at energy prices, which I think our country is on a good path, we need to keep those down. It affects everything that we do.
Yeah.
And if we allow our energy prices to continue to grow, all our prices are going to grow with it.
Yeah.
That's just an input cost on everything that we have. So we keep a close eye on energy. I like the fact that we have more energy right now, and it's going to keep inflation low. So that's
I saw
really
a study
important.
one time, and I can't remember the exact numbers, but for every dollar, for every dollar per gallon swing up or down, it's hundreds of billions of dollars, maybe even $1 trillion swing in the economy, either out of the consumer pocket or back into the economy, spending on other things. And so it's crazy how widespread that cost per energy source affects everybody.
If you can drop the energy costs, people paying less at the pump, they're going to spend elsewhere.
Yeah, and when you factor that in through the entire economy, that's an insane number.
It's huge.
Yeah,
it really is.
All right, the other topic that seems to make a lot of headlines, of course, are interest rates and the Fed fund rate. And there's a lot of talk about the Fed fund rate. We chuckle because I think people misunderstand a lot. People are hammering, and I realize a lot of times that comes with what's on TV.
Yeah,
people are hammering the Fed to lower rates so they can pay less for their mortgage. Doesn't necessarily work that way.
No.
So maybe let's get into it a little bit on just help educate our folks.
All right, so I want to give you a definition of the Fed funds rate because a lot of people don't understand what it is. So the federal funds rate is the target interest rate range at which commercial banks borrow and lend their excess reserves to each other overnight, which is set by the Federal Open Market Committee.
Okay.
Does that affect you in everyday life?
Well, it could, but not in the way
people think it is.
Right.
Yeah. So when you have a decrease in the federal funds rate, what it's actually doing is it's taking money out of your pocket.
Exactly.
Because all of your interest rates are going down. Yeah. Okay.
Those high yield money market rates.
Yep. But we want the mortgage rates to go down. Well, did it say anything in the definition about mortgage rates?
It does not affect the mortgage
rates. So the
rates.
federal funds rate does not affect mortgage rates.
I think that's important for people to understand.
It's very important. Yeah. And if you got somebody, a family member, you're looking to buy a house, that's not what you need to be looking at. Right. Although it's really exciting because it comes out, and, it's on the news, and this is supposed to affect everyone. Well, if you're not a bank, it really doesn't affect you that much.
That's right. So speaking of mortgage rates, because I think that's where most of our folks focus on, what do those look like, and what does the 10-year mortgage treasury look like? Mortgage
rates are backed by actually they follow the 10-year treasury. Okay, and we'll put a chart up there. This is from the Federal Reserve Bank in New York. The bottom line is your Fed fund rate. Your 30-year is the top blue line. You can see that it doesn't follow the Fed funds rate much at all. Okay. However, if you go down to the next slide, which is the mortgage rates versus treasury yields, you see that is really what's going to dictate where your mortgage is.
Those work in concert. Yep.
That's correct. Not the federal funds rate.
Right.
So there's a lot of A lot of confusion there.
Yeah.
Yeah, we wanted the rates to go down and won't go down with federal. Well, it has to do with supply and demand.
Sure.
Now, if you take a look to the very right of this chart, you're seeing the 10-year Treasury and the 30-year mortgage get far apart. Okay. And you look through the years, and there's not many times that this happened. In 2000, it happened. In 2008, it happened. And what's happening here is the mortgage companies, the lenders, are taking a look at interest rates going down.
Right.
And if they loan you money at we're closer to the 10-year interest rate, well, when it goes down even more, you're going to refinance and they're going to lose that loan. So what they're doing is they're building in some profit.
Yeah, they're slower to react a little bit off of that, and also a fear if things do reverse, they're gonna get caught.
They're gonna get caught. Yeah. So, if I'm a bank and I'm gonna loan somebody money on their house, I know interest rates are probably going to go down. I'm going to get a little bit more rate for it. That's because they're eventually going to refinance and get out.
They typically are slower to adapt on the way down, but they're going to be quick to reset the rates if
that's
go
correct.
on the way up.
That's correct. But rates right now, the mortgage rates right now, between 5% and 6%, I think that's where they need to stay. Yeah. The only thing that the Fed has to control our economy from spiraling out of control is interest rates.
Right.
They can lower them if we're doing bad. They can raise them if we're doing really good.
Right.
So lowering them too much takes the power out of our government to fix any issues that they create.
That's right.
I'm saying they create all the issues.
and historically speaking, the mortgage rate in that 5 to 7% range is very normal, and our economy's done very well with that range, and it goes hand in hand also with home prices. So, we'll see what that looks like
right. And
going forward.
If you're looking to buy a house, buy the house that you can afford at this rate right here.
Yeah.
Don't buy the house where you think the rates are going to go down, because we don't know if they're going to go down.
Right.
So make sure if you're buying a house, you can afford where you are buying right at the moment.
Yeah. No, great point. So last few items of discussion here on our first podcast of the year. Let's talk about consumer sentiment, the feelings about the economy, because sure, the markets, the stock markets have been doing well. When we look at, and we'll look at some of these in a second, the GDP numbers are still coming in very strong. But I feel like a couple slides ago when we talked about inflation, rising costs of, or not rising, but the costs that have stayed up there, especially in the food, housing sectors, have people feeling that maybe the economy is still pretty bad, because, like you said, those costs are not coming down. So
they're not.
So talk about consumer sentiment, and also maybe discuss this whole idea of the K-shaped economy that we're in, sort of where we have, you're over. It seems like if you're over 50, you have a lot of equity in your house. You have big retirement account. Stock market's done well. You've done really well in your house, your home. Even though inflation has hit maybe at the supermarket, you're still feeling pretty good about yourself.
Yep.
And then we have the sub 35-year-old who cannot buy a house right now, is getting maybe hit a little harder with the cost of living, is still renting at exorbitant prices well above what they were maybe 5 years ago, starting a family, and they're on the struggle bus. So maybe talk about those couple things, and maybe that's how the feelings about the U.S. economy lies.
Well, on the chart I have, it shows that the consumer sentiment is as low as it was in 2008. It's lower than 99, and it's somewhere around 78, 79. Nixon resigning the first oil shock, when people really didn't have a lot of confidence in what was going on. That's where we are right now.
Right.
And it's kind of scary. However, if you take a look at the data, now this data shows that they're concerned, but Christmas this past year broke records.
Right.
And they're talking about, we may not have a great Christmas. Well, people are still spending money.
People are still spending money.
They're still spending money.
I've heard you say it a million times. The only thing that matters in our economy is the velocity of money
through the economy. Even though they're a little bit nervous, and there's a lot to be nervous about. You've got the news just barking out this stuff that makes people scared. That nothing we can control. But there's a lot of people out there that want people to be nervous, people to think this way. The reality of it is, we're doing pretty good. Our economy's doing good. Our country's doing pretty good. Our GDP is doing very well too. There was a lot of fear that the tariffs that came out at the beginning of the year were going to cause a lot of inflation. We're not seeing that.
We have not seen that come through yet.
And now what's going to happen is with the big beautiful bill. I don't know what else to call it.
That is what people are calling it.
We're going to get some tax breaks for the lower income people. No tax on tips, no tax on overtime. Yeah. If you're collecting Social Security, there's a good portion of Americans that aren't going to pay on Social Security.
Yeah, and we're starting, so at the end of the year and the first couple weeks here in January, we've started doing some just projections on some of our clients, particularly some of our senior folks, and the numbers are real. What I'm seeing, significant money going back to them or them paying less tax. And these are folks that are all making under 150 in retirement, either through investment, Social Security, whatever it is. Yep. That new senior tax break they're getting, the higher standard deduction, the extra charitable deduction. So all of those things are really sending money back toward the intended recipients, I think, in those senior citizens.
And I hear a lot on TV that they're doing this to give the rich these big tax breaks. What a lot of people don't realize, if you make over a certain amount of money, every dollar is taxed at 37%. There's not big tax breaks out there for them. I mean, you get hammered if you make over a certain. It doesn't matter what you're looking at. But the big tax breaks are coming to the people that actually need them. Yeah. And that's going to be strong for the economy because there's going to be more money to be spent.
Right. And when you say big tax breaks, I think it's, I think a lot of people focus on the dollar value, which is fair. I mean, look, that's a political argument, but I think when you say the most significant in terms of helping day-to-day people, again, that whole consumer sentiment, I got more cash in my account. Yep. I'm not having to, again, you get a bigger refund in April. I'm not having to pay the IRS, whatever that looks like. They're going to have more money in their accounts.
That's correct.
Throughout the year because they're paying less tax.
And that helps with consumer confidence. When you have a little extra money, if your energy prices go down and you get a little bit more in your paycheck, that's going to be huge for them.
100%. Yeah. So those are all important factors. And again, we look at the GDP numbers here. I think that's, again, one of the themes that people come up with. And again, I think it's just when you look at the media out there, it can be fearful. But I love this chart because it really shows how big the U.S. economy is.
And they don't talk about that a lot.
No, I mean we're bigger than the next four combined or next 3 or 4 combined. So
they don't talk about that a lot. So when you look at strength, people talk about the strength of the dollar, or is the dollar going to fall off and somebody else going to take it over? But when you take a look at the U.S.'s GDP, it's almost $31 trillion. Yeah. Next in line is China, which everybody thinks they're so big. Right. They're at 19 trillion. Yeah. They're a little less than half of what we are. And you go down to Germany at 5 trillion. Canada's only at 2 trillion. Yeah. And we're at 30 trillion. Yeah. So when you look at buying power, there's a reason why when the tariffs started coming up, all these countries came to the U.S. They do not want to lose the ability to trade with the U.S. because it's huge.
Yeah, well, they can't afford. You can't afford to.
No country can afford.
Right.
Because you look at the numbers.
Yeah, they need to figure it out somehow.
Yes, and if they got to pay a little extra, it's better than letting it all walk away.
Right. And when you look at the numbers 2, 3, and 4 there, they've got serious issues, and this is probably another topic for another podcast, but they've got population issues going on where they've got massively decreasing population numbers over the years. And so they're staring, when really you look at India as maybe, India's going to surpass those 3 over the next 5 years.
They will because of their population.
Quickly. Yep.
And China's population is going down. The one-child rule, I think, hurt them long term. Yeah. And you take a look, let's say, they said they had a billion people. There's coming in around 700 million. Now they got 700 million. We've got 30 million, 35, 40 million. Or 300 million.
300, yeah.
300 million.
Approaching 400. Yeah.
400 million. And we're 30 trillion and they're 19.
Yeah.
GDP per person.
Yeah, I think I was going to point you to that. The far right column is very telling there.
Oh, yeah. GDP per capita the U.S. is doing extremely well.
That's right.
We just need to continue doing that.
That's right.
We need to bring business back, jobs back. We need to continue to do this and turn the government off.
Yeah.
Turn it off.
I'll keep saying it, protect the free market capitalist society. That's what built this country.
And it's all about money up there. They just want money and control.
They want to stay in control. Yeah. Both sides.
Both sides. It doesn't matter who it is. I don't like any of them.
They're agnostic.
They are. It's horrible.
And of course, our last slide. Many CPS clients and fans of ours have seen this many times. Mm-hmm. I think we've updated to reflect 2025 there with the tariffs, the Fed, and the government shutdown.
I said the Fed because I'm going to fire. I'm going to fire Powell, and then all of a sudden, boom, the market goes. Just keep an eye on what's actually going on in the economy, not what people say.
Well, Pete, thanks again. I'm sure we'll be playing some of these clips throughout the year to either prove us right or prove us wrong.
Well, I hope prove us right, but
right,
hey, it goes both ways.
It goes both ways. We're equal opportunity
That's
here.
Right.
We'll fess up to our misses and certainly celebrate our wins. Yeah. But Happy New Year to you.
Happy New Year.
Healthy and happy New Year.
And you too. And just remember, when you're investing hard-earned dollars, make them pay you.
That's right.
Get some dividends out of it so you take and reinvest those. Yeah. You want to create an income stream so you can replace what you're
super important.
Very important. Don't forget that.
All right. And if you like this content, please don't forget to subscribe to us on our YouTube channel. And as always, you can reach us at www.cpsinvest.com or feel free to give us a call at the number on your screen. We'd absolutely love to hear from you.